Welcome to our webinar today. I am Ben Sutton, CPA here at Mazuma, here to discuss financial reports and what they mean, how to understand a little bit more about your business by reading your financial reports. Now, unfortunately, we are not going to be able to cram a 5-year accounting degree into 30 minutes. And so, if you walk away with some questions still, don't worry. It's not going to be any surprise. However, hopefully today we lead you down a path of understanding how your reports come about and also why they are actually better as a gauge of what is happening in your business than looking at your bank statement or your bank balance. Okay, so we're going to begin with a bank statement. Okay, this is something that we're all familiar with. We've got our bank statement here. We've got the beginning balance. We've got some transactions and our ending balance. Okay, so our business today is a pest control business. That's our example. And we've started this business in September with a $10,000 bank loan. Okay, so we went to the bank, filled out the applications, got our money. We're in business. We go out on the 2nd of September and purchase $200 worth of chemicals. On the 3rd, we go, next of course, we got to tell people about us, do some marketing, purchase $500 on Google ads. And cha-ching, September 4th, we got our first customer, $150 income, all right? They pay us to go out and do a job. Now it's time to drive out there and spray their weeds, spray their pests. We go get some gas at Chevron. On the way, we stop at Mickey D's, get $10 worth of food, and complete the job. All right, we're back. On the 10th, our next customer, cha-ching, $150 in the bank. Chevron again, Mickey D's. I'm feeling a little indigestion, two Mickey D's trips within 5 days, but, so $10 worth of Mickey D's. Then I'm getting pretty confident that this business is going to take off, all right? So I go plop $2,500 down on my a new Apple computer, all right? The 16th, my third customer pays me. I am rolling in the dough, all right? So it's time to pay myself. I pull out a $500 owner's distribution. And lastly, I make a payment on my loan to the bank for $250. Okay, so that leaves me with an ending balance of $6,440. All of these transactions, we're familiar. You can look at your bank statement, you can look at all of the transactions, and you can know what that's for. I went to Home Depot for this, I went to Walmart for that, right? Now, how does this information become information to you on a profit and loss statement? And that's going to be our next phase, okay? Now, one critical element here is that not all of these transactions end up on an income statement. Not all of them apply to the profit and loss, okay? And this is where some of the accounting rules come in that, if you haven't gone to college for this stuff, who's going to know this, right? But, so, just as an example, let me just blow through right here and tell you what applies and belongs on the profit and loss statement and what doesn't, all right? Our bank loan, that's not really an income item, right? I just borrowed money, so it's not income. It does not belong on the profit and loss. It's a liability. It's a loan. It belongs on the balance sheet, which we're going to talk about. Chemicals, I go out and buy chemicals. Supplies is an expense. Google ads, marketing expense, right? Income from a customer, income. Any income and expense items are going to the profit and loss, okay? Income, gas, expense. McDonald's, food, expense. Income, and so on. Now, the next one that does not belong is this computer. Now, you may ask why. You need a computer to run. Isn't that an expense? Well, yes. However, when you buy large assets like that, things that cost more than $2,500 in general, and things that are going to benefit your business over the long run, accounting rules and the IRS require you to capitalize those purchases into what we call it a fixed asset. All right, and you get to deduct or expense that item over time using depreciation, which is something you may have heard of before. And so this computer belongs on the balance sheet as a fixed asset and will be depreciated over time. Customer income belongs on the P&L. Owner's distribution, when I pay myself money out of the business, is that an expense to the business? No. It's an owner's distribution. It's coming to me personally, right? I'm the owner. So it's an owner transaction. It does not go on the P&L. It goes on the balance sheet. Okay? Our payment on the bank loan. It's another example of something that does not belong on the P&L. You're paying down that liability that you incurred at the beginning. So since that liability, that $10,000 that came in, was not counted as income, the payments on that loan is not going to be counted as an expense. All right? So here's the transactions we're dealing with. Hopefully you followed through that. We're going to move on now to our profit and loss. All right, so how in the world do we go from all these transactions to a beautiful profit and loss statement? And that's what we're going to show you right now. All right, so all of those profit and loss related transactions we're going to handle, okay? The first one, chemicals, $200. Marketing, $500. Then we've got 3 income transactions. Customer 1, customer 2, customer 3, all of these grouped together, and that's where we begin, the income. So we add up all of our customer transactions, all of our income transactions, $350 transactions adds up to $450 of total income. See that magic right there just happen? 3 transactions add up to our total income number of 450. Okay? Ready for some more magic here. We got 2 gas transactions, Chevron and Chevron. We're taking that down to the auto expense. 2020 equals $40. Okay, here it's coming together. You see it? McDonald's come together. Total meals and entertainment, 20. 10 plus 10 is 20. All right, now let's go back to our just single items. Okay. Chemicals. Chemicals has its own little category here in our business. It goes under cost of goods sold, $200. Why is chemicals in cost of goods sold instead of expenses like the auto and meals expenses? You know, every industry is different with this rule, but generally, cost of goods sold is meant for expenses that are required in order to produce the service or product that you are offering the public. All right, so in your business, what is absolutely critical that you pay for in order to provide your product or to provide your service? All right, in order to go out and spray people's pests or weeds, I have to have the chemical. All right, like that's my main cost associated with going out and getting the job done. And so now That's one example. Like I said, industry by industry is different, and there's no hard and fast rule. Most of our clients don't have a cost of goods sold section. It's not required. It's more management kind of deciding what they want to see on the P&L. So that's why chemicals we've broken out into this separate cost of goods sold category. All right, we've taken good care of chemicals. Next one, Google Ads. It's a marketing expense, right? $500 in marketing expense. Okay, so the magic that just happened, I know it's blowing your mind right now, but all we did was categorize all of these transactions. Okay, we said chemicals is a cost of goods sold transaction. Google Ads is a marketing transaction. Chevron is an auto expense. McDonald's is a meals expense. And then we just group them together and add them all up. Okay, and we put up the totals of what those transactions add up to on the appropriate line of the profit and loss or income statement. Okay, so where are we at here? We've got $450 of income, $200 of cost of goods sold, $40 of auto expenses, $500 of marketing, and $20 of meals and entertainment. When I take my total income and subtract all of my expenses, I arrive at a net loss in this situation. So we've got a negative 310. It's a new business. I'm not too worried, right? It's normal to operate at a loss in the new business. So this is exactly how your profit and loss comes together. And once it's just adding, right? Adding and subtracting. I've added up all my transactions to group everything here. And then I've done income minus all my expenses to get to my net loss of 310. Now, why is this information valuable? Well, you can tell already there's a little bit of a disconnect between how much cash I have in the bank and what happened this month, right? I've still got $6,400 in the bank. I'm rolling still, right? I got plenty of money. But this is telling me maybe something a little different. I spent more money than I took in by $310. And then the question begs, well, wait a minute, what happened to the owner's payment and the fixed asset that we talked about? How does that all factor in? That all shows up on the balance sheet, and that's what we're going to go to next. All right, so we've just seen the magic of the profit and loss or income statement. I've been referring to profit and loss. In accounting terms, that is synonymous with income statement, just so you're aware. So I've just walked you through how these transactions, right, become a profit and loss statement that actually begins to summarize activity. And now we're going to address those transactions that we said did not belong on the profit and loss, okay, that belong on the balance sheet. We've got our balance sheet over here. Top line is almost always cash, okay? And this balance sheet is as of the end of the month, okay, as of the end of a certain period of time. So as of 9/30, I've got $6,440 in the bank, okay? Simple. There's my cash balance, all right? $6,440. I have purchased some fixed assets. Spent $2,500 on that nice MacBook, right? So that transaction gets pushed right there to the fixed assets section of the balance sheet. Okay, it represents an asset that I own. It's valuable, right? It's different than the McDonald's that I ate 2 weeks ago. It's not valuable anymore. The computer is, all right? So that shows up on my balance sheet. Total assets are around $8,940, I believe here. So add up your cash, your fixed assets. Now, there could be, of course, if you've looked at your balance sheet, there's possibly some other categories here, and that's fine. You don't have to have a lot of categories. There's no required categories. Okay, it's just what you have shows up on the balance sheet. We finished our assets section of the balance sheet. Moving on to our liabilities section. Liability refers to money that we owe. Okay, credit cards, loans, auto loans, things like that. So we do have a bank loan. If you recall, we started our business with a $10,000 loan. Towards the end of the month, we paid our $250 payment. Now we're going to disregard interest here for simplicity's sake. So we paid $250 on our $10,000 loan. We got a $9,750 balance at the end of the month. All right? That's all the money we owe out. Now we have our equity section, which ends up being the most complicated element of a balance sheet most of the time. However, in our simple case here, it's not going to be bad. We've got owner's distributions. If you recall, I was feeling great about the work I accomplished during the month and paid myself $500. So I've got a $500 owner's distribution in the equity section of my balance sheet. This last item, on your balance sheet you may see a label there called retained earnings. You've probably heard of retained earnings before. Retained earnings represents your net income over many periods of time. Okay? In the first month, all we have is net income. We don't have any net income from prior months. We just started our business. Okay, so in our simple example here, we got a negative 310 net income for our first month of operations in September. So we are almost done with our balance sheet. We've got $89.40 of assets, $97.50 of liabilities, $500 in owner's distribution, $310 in a net loss. Okay, we add up the liabilities and equity section together for a total of $89.40. Imagine that. Balances, right? That's why it's called the balance sheet. Assets always equal liabilities and equity if you've done your accounting right. Okay? Double entry accounting requires those rules to remain in place. And so if you go through college, this is one of the biggest hurdles, right? Biggest things that you have to learn in accounting classes. Debits and credits, assets equals liabilities and equity. I don't expect you to fully understand it, of course. However, it wouldn't surprise me if you can see how we've come from transactions, grouping the numbers in our P&L, and then finding the balances of our assets, liabilities, and equity to put together our financial statements here. All right, so we have our full set of financial statements. Now what? How is this helpful, right? In our next segment, we're going to address that. All right, are you ready for the culmination of this presentation, all right? Before we get to that, before we start drawing conclusions from these reports, I want to illustrate and explain something to you that will help you orient yourself on each of these statements. The income statement or profit and loss is a representation of a period of time. Okay, in our case, September 1 through September 20th or September 30th, end of the month. This represents what our activity over that period of time. It's multiple transactions during that period of time being added up to reflect what we've done. Okay? The balance sheet, on the other hand, is not a representation so much of a period of time as it is a representation of a point in time. It's a snapshot right now at the end of the month. What did I have? What did I owe? Okay, and what did I make in the business? All right, so keep that in mind, and that's a very powerful principle if you understand that period of time, point in time. Okay, now let's start drawing some conclusions about my activity in my business this month. Why did I take $500 out as the owner? Well, I knew I worked hard. I knew I still had money in the bank. Might as well pull money out, right? Well, if I had known that I had lost $300 this month, in that I spent $300 more than I had earned, I might have thought twice a little bit about pulling $500 out to put in my own pocket, right? Especially knowing that the only reason I had that $500 in the bank was because I borrowed it for the business. All right, so looking here in order to determine how much money is available to me as the owner is a wise way of running your business. Because how long would that last? If I kept generating $300 losses every month and kept pulling $500 out every month, I'm going to run out of money. Okay, so I know now that I've got to get this number up. I've got to get that income number up so that I start turning a profit, and instead of losing money, making money, ending up with more cash in the bank than I began the month with. Right, that would be the goal. And that would then inform my decision about pulling money out of the bank. Okay? So again, you've got to disassociate your cash balance from knowing what you can pull out for yourself. And the only way to do that is with a profit and loss, an income statement, to show you what your activity has been. Okay? Now, number 2 major conclusion here. A lot of small business owners feel like when they pull money out of the business that they're going to be taxed on that money. Okay? I pulled $500 out as an owner's distribution into my own bank account, cha-ching. Uh-oh, I got to worry about the taxes on that. How much taxes am I going to pay on $500? It doesn't matter, because what you're taxed on is actually this number. Okay? So your net income is the result of your activity over a period of time. And the IRS, fortunately, is not going to tax you unless you have made money, unless you have income. It's income tax, right? So you have to make money in order to be taxed. So they want you to look at the full year and perform this analysis and say, what was your net income? That's what we're going to tax you on. Which makes sense, right? It's logical. The IRS is not going to tax you on unless you have money, right? So you've got also to disassociate this owner's distribution from your tax. Don't look at how much money you're taking out of the business to determine what your tax liability is going to be, right? In this case, we've got a loss, If I ended the year with a loss, I owe nothing in taxes, even though maybe I pull $1,500 out of the bank. Okay? So, rule number 1, don't manage your business off of the cash balance. Manage your business off of the profit and loss. It's a pure representation of what has happened over the past period of time. Number 2, don't try and estimate taxes based on how much money you pulled out of the company. It doesn't matter how much money you pull out of the company. You could leave all the money in and still be taxed if you've got a net profit here. So there's our 2 primary conclusions that we hope that you can take away from this presentation and also from your financial reports. You know, this is a relatively simple procedure when we've got 12, 13 transactions. We started with a 0 balance. It's brand new business. We've been in business 1 month, and we've had just a few transactions to account for. It becomes a lot more complicated. You can imagine when you've got hundreds of transactions per month. You got credit cards. You got 3 bank accounts. You've got auto loans and bank loans. You've got multiple owners taking money out of the business maybe. You got payroll. You got all kinds of other strange transactions that aren't as obvious as Chevron gas, right? So you can imagine this is why small business owners often don't do their own bookkeeping and shouldn't do their own bookkeeping, because it's just so much time to go through this detail. And however, on the other hand, it's critical for small businesses to have this information and to understand what they're looking at and to draw those 2 critical conclusions from these financial statements. How much can I take out of my business? And what should I be looking at tax-wise at the end of the year?